When we talk about the stock market, one thing becomes crystal clear. Nothing becomes crystal clear. Nothing is ever guaranteed. Stocks can soar for months, even years, and then suddenly reverse course in a single trading day investment. And that's exactly why today I want to break down the top 5 stocks that could crash tomorrow. Not to scare you, but to sharpen your awareness so you can protect your portfolio and make smarter decisions. Investment. Let's start by understanding why crashes happen. Markets are incredibly sensitive to sudden changes. Economic reports, earnings misses, geopolitical tensions, or even a single controversial tweet can trigger panic. Investors often focus on the upside potential and completely overlook the downside risk. And here's the kicker: those overvalued companies that everyone raves about are often the most vulnerable. When the fundamentals can't justify the stock price, even a small negative catalyst can trigger a massive sell-off. One of the stocks on my radar is stock A. It has been climbing relentlessly, boasting sky-high price to earnings ratios that just don't make sense. Analysts are starting to question the company's growth projections, and any hint that these numbers won't materialize could send investors running for the exits. Then there's stock B, a tech darling that has relied heavily on hype rather than consistent revenue growth. If their next earnings report misses expectations, even slightly, it could create a domino effect across the sector, dragging other stocks down with it. Sector-specific vulnerabilities also matter. Investment. Consider stock C in the biotech space. These stocks are notorious for being binary. A single FDA approval or rejection can make or break the company. Investors who bought in at the peak of optimism may not be prepared for a sudden downturn, and that panic can snowball quickly. Stock D, a financial stock, faces risks from rising interest rates and new regulations. Changes that seem minor on paper can hit confidence hard, and when investors lose faith, the stock can plummet faster than anyone anticipates. Finally, stock E, a highly speculative cryptocurrency-related stock, embodies the extreme volatility of hype-driven markets. Sentiment swings, rumors, or regulatory announcements can wipe out billions in market cap almost overnight. And this brings me to a critical lesson. It's not always the fundamentals that drive short-term crashes. Sometimes it's investor psychology. Fear spreads faster than facts, and herd behavior amplifies the drop. So, what's the takeaway? Awareness is power. Investment. If you own any of these stocks or similar ones, don't panic, but don't ignore the risks either. Have a plan, set stop losses, reevaluate your position. Remember, investment. Protecting your capital is just as important as chasing returns. Markets will always have winners and losers, but the smart investor is the one who prepares for both. Investment. Being aware of potential crashes doesn't make you negative. It makes you informed, disciplined, and ready for whatever the market throws at you. The stock market is inherently unpredictable, and the very nature of investing carries risk. Understanding market volatility is critical for any investor who wants to avoid unpleasant surprises, especially when we are talking about stocks that could crash seemingly overnight. Market volatility refers to the rate at which the price of a stock or the overall market rises or falls for a given set of returns. It is essentially a measure of risk and uncertainty. High volatility means prices can swing dramatically in a short period, both up and down, while low volatility indicates relatively stable price movements. Investors often underestimate how quickly sentiment can shift in the market. One moment, a stock can be experiencing a bullish rally with everyone confident in its future growth, and the next, investment, a minor piece of negative news can trigger panic selling that causes the price to collapse. Several factors drive market volatility. Economic data, such as employment reports, GDP growth figures, and inflation numbers, can move markets because they impact investor expectations about future growth and interest rates. For example, if a key report shows that inflation is rising faster than expected, investors may anticipate that central banks will raise interest rates, increasing the cost of borrowing and potentially slowing corporate earnings. This anticipation alone can trigger selling, even before any actual economic consequences take place. Similarly, geopolitical events, trade disputes, or unexpected policy announcements can create sudden uncertainty. When investors are unsure about the future, fear often overtakes rational analysis, resulting in sharp declines in stock prices. Volatility is not just about macroeconomic events, it is also about company-specific risks. Stocks of companies that have high levels of debt, declining profit margins, or uncertain growth prospects can experience drastic swings. Even highly praised stocks are not immune. A missed earnings report, an executive scandal, or negative industry news can lead to sudden and severe drops. For investors, recognizing these risks ahead of time can mean the difference between a manageable loss and a catastrophic one. Investment. It's important to pay attention not only to the company's fundamentals, but also to the broader market environment and the mood of investors. Another element of volatility is the psychological factor. Investors' emotions can amplify price swings. Fear and greed are powerful drivers in the market. During bullish periods, overconfidence can push stock prices far above their intrinsic value, creating bubbles. Conversely, during bearish phases, fear can cause panic selling, pushing prices below what the fundamentals justify. This combination of external economic pressures and internal investor psychology makes market volatility a double-edged sword. It presents both opportunities and risks. To navigate volatile markets successfully, investors must develop a disciplined approach. Understanding that stocks can rise and fall rapidly prepares you mentally to handle sudden movements without making impulsive decisions. Diversifying your portfolio, investment, setting stop-loss orders, and maintaining a long-term perspective are essential strategies to mitigate the risks associated with market volatility. By acknowledging that sharp declines can happen at any moment and preparing accordingly, investors position themselves not just to survive, but to thrive even in uncertain market conditions. In essence, being aware of market volatility is about more than just acknowledging the risk of loss. It's about understanding the forces at play, anticipating potential triggers, and cultivating the mindset and strategies needed to navigate the unpredictability of the stock market. Those who underestimate volatility often get caught off guard, while those who respect it can make informed, strategic decisions that protect their capital and maximize their long-term potential. When it comes to investing, one of the most critical things to understand is the concept of overvaluation. Investment in overvalued stock is one whose current market price is significantly higher than its intrinsic value, which is usually determined by analyzing financial statements, growth prospects, and the company's competitive position. Buying overvalued stocks is extremely risky because the price is often driven by hype, speculation, or market trends rather than solid fundamentals. When the market finally recognizes that the stock cannot justify its lofty valuation, a sharp correction, or even a crash can follow. This is why identifying overvalued stocks is crucial for any investor who wants to avoid sudden losses. Overvaluation can happen for several reasons. In many cases, investors become enamored with a company's narrative rather than its numbers. Perhaps a tech company launches a highly anticipated product, or a social media platform suddenly goes viral. The excitement can push demand for the stock far beyond what the company's earnings or revenue growth can support. Similarly, in a bull market, investors often chase trends, investment, piling into hot sectors without scrutinizing the underlying fundamentals. This herd mentality inflates stock prices, creating what is essentially a bubble waiting to burst. When a correction occurs, the losses can be swift and dramatic. Another key factor is price to earnings as a PE ratios. A PE ratio compares a company's stock price to its earnings per share. A high PE ratio may indicate that investors expect significant future growth, but if those expectations are unrealistic, the stock is overvalued. For example, a company trading at a PE of 200 may have investors betting on exponential growth that is highly unlikely. When earnings fail to meet expectations, investors quickly lose confidence, triggering mass sell-offs. This is why it's essential to compare a company's valuation not only to its own historical performance, but also to industry peers and overall market standards. Overvaluation isn't limited to individual stocks. Entire sectors can become overpriced. Tech, cryptocurrency, or speculative biotech sectors often see periods where prices surge far beyond reasonable expectations. In these cases, even strong companies can suffer if the overall sector sentiment shifts. A single negative event, like a regulatory announcement, poor earnings report, or market downturn, can ignite panic, dragging down multiple stocks at once. This is why understanding sector-specific dynamics is just as important as analyzing individual companies. Finally, investors need to recognize that overvaluation often coincides with increased volatility. Stocks that are priced above their intrinsic value are more sensitive to news, sentiment shifts, and macroeconomic factors. What might be a minor announcement for a well-valued stock can become a catalyst for a major decline in an overvalued one. Savvy investors must therefore constantly assess valuation metrics, understand growth projections, and evaluate whether market optimism is justified. By doing so, they can avoid being caught in a sudden crash and protect their capital from unnecessary risk. Ultimately, Recognizing overvalued stocks is about balancing optimism with realism. High growth and innovation are exciting, but prices must be supported by concrete fundamentals. Investors who ignore overvaluation are essentially gambling, while those who pay attention to valuation can make informed decisions, avoid severe losses, and navigate the market more strategically. Understanding the risks associated with overvalued stocks is not just a defensive tactic. It is a fundamental principle of intelligent investing that can safeguard wealth in unpredictable markets. Investing isn't just about picking individual stocks. It's also about understanding the broader sectors in which these companies operate. Different industries have unique risks and vulnerabilities investment, and these sector-specific factors can dramatically influence a stock's potential to crash. For instance, technology, biotech, energy, and financial sectors are all exposed to distinct pressures that can trigger sudden downturns, often in ways that investors don't anticipate. Recognizing these vulnerabilities before they materialize is crucial for anyone seeking to protect their portfolio. Take the tech sector as an example. Technology stocks are often fueled by hype, innovation, investment, and the promise of exponential growth. Investors are willing to pay a premium for companies that seem to be the next big thing. However, tech companies are particularly sensitive to earnings misses, regulatory scrutiny, and market sentiment. A single disappointing earnings report or a negative announcement regarding privacy concerns, product recalls, or competition can lead to a rapid drop in stock prices. In this sense, even companies with strong fundamentals aren't immune if the sector as a whole is experiencing turbulence. Biotech is another sector with inherent vulnerabilities. These stocks can skyrocket on the news of a potential breakthrough, only to collapse just as quickly if a drug fails in clinical trials or regulatory approval is delayed. The binary nature of biotech investing makes it extremely volatile. Investors who ignore this reality may find themselves facing sudden and severe losses. Understanding the sector-specific risks allows investors to differentiate between hype-driven surges and sustainable growth opportunities. The energy sector, particularly oil and gas companies, is heavily influenced by global events, supply-demand dynamics, and government regulations. Prices can swing dramatically due to geopolitical tensions, changes in production quotas, or new environmental policies. Stocks in this sector often react more sharply to external shocks than stocks in more stable industries. Investors who fail to account for these sector-specific risks can be blindsided by abrupt downturns in investment, even if the company itself appears financially sound. Financial stocks, including banks, insurance companies, and investment firms, have their own vulnerabilities. Interest rate changes, regulatory reforms, or exposure to bad loans can quickly affect earnings. During economic slowdowns or credit crises, these vulnerabilities are magnified. Even well-managed banks can suffer from systemic issues that ripple through the sector, causing investors to panic and sell off shares rapidly. Understanding sector-specific vulnerabilities also involves recognizing correlations between industries. For instance, tech and consumer discretionary stocks can be impacted by the same shifts in consumer sentiment or economic trends. Similarly, energy and transportation sectors often move together based on fuel price fluctuations. When one sector experiences trouble, the effects can cascade across related industries, amplifying the potential for a broader market correction. In conclusion, sector-specific vulnerabilities are a critical factor when evaluating the risk of a stock crash. A company's individual fundamentals are only part of the story. The health, trends, and pressures within its sector play an equally important role. By analyzing these dynamics, investors can anticipate potential pitfalls and take precautionary measures, such as diversifying across industries, monitoring macroeconomic indicators, and staying informed about sector developments. Being aware of these vulnerabilities doesn't guarantee immunity from market swings, but it equips investors with the insight to make smarter, more strategic decisions and reduces the likelihood of being caught off guard when volatility strikes. One of the most overlooked yet powerful drivers of stock market crashes is investor psychology. Human behavior, emotions, and collective sentiment often play a far greater role in short-term market movements than company fundamentals or economic indicators. When fear spreads through the market, it can create a self-reinforcing cycle that accelerates a stock's decline, sometimes causing prices to plummet far below what rational analysis would suggest. Understanding how investor psychology works is critical for anyone who wants to anticipate or survive sudden market downturns. Fear is arguably the most potent psychological force in the stock market. When negative news hits, be it disappointing earnings, regulatory concerns, or geopolitical uncertainty, investors often react emotionally rather than logically. Panic selling becomes contagious. Investment. One investor's decision to sell can trigger a wave of selling by others, creating a snowball effect that drives stock prices sharply lower. This is why stocks that might appear fundamentally sound can still experience sudden crashes. It's not necessarily about the company itself, but about how investors perceive risk and react to perceived threats. On the flip side, greed and overconfidence can also contribute to volatility and potential crashes. When markets are rising, investors often become overly optimistic. Investment. Chasing returns without evaluating the underlying value of a stock. This can inflate prices far beyond what fundamentals justify, creating bubbles. Once a negative catalyst hits, no matter how small, the bubble bursts and the crash can be swift and severe. The psychological interplay between greed and fear creates cycles of boom and bust, which can be seen repeatedly throughout market history. Herd behavior amplifies this effect. Investors frequently make decisions based on what others are doing rather than their own analysis. If a large number of market participants begin selling a stock, investment, even those who initially intended to hold may panic and follow suit. This collective behavior can transform a minor setback into a full-blown market correction. Conversely, during rallies, and herd behavior can push prices to unsustainable highs, setting the stage for dramatic reversals. Understanding this dynamic is essential in investment because it highlights that crashes are often not purely rational events, they are emotional ones. Psychology also affects the speed at which a stock can fall. In highly liquid markets, information spreads almost instantly, and sentiment shifts can trigger massive sell-offs within hours. Social media, news platforms, and investor forums can amplify fear, spreading panic faster than ever before. This is particularly evident with highly speculative stocks, where retail investors can coordinate buying or selling activity that drastically impacts prices. Awareness of these psychological factors can give investors an edge by helping them anticipate potential sell-offs and adjust their strategies proactively. Finally, being aware of investor psychology allows for better risk management. Recognizing that fear and panic often exaggerate market movements, disciplined investors can maintain perspective, set stop-loss orders, and diversify portfolios to protect themselves from sudden downturns. They can also identify opportunities when fear drives stock prices lower than they should be, using market psychology to their advantage rather than being controlled by it. In short, investor psychology is a silent but powerful force behind stock market crashes. Fear, greed, herd behavior, investment, and overreaction can push stock prices far beyond what fundamentals dictate, creating both risk and opportunity. By understanding these psychological dynamics, investors gain the insight to anticipate potential crashes, protect their capital, and make rational decisions even when the market around them is in chaos. Those who ignore this human element often find themselves caught off guard, while those who embrace it can navigate volatile markets with confidence and strategic foresight.